Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I'm just going to give a quick market update on some of the things that I've been reading, and some of it I'm sure all of you have been reading as well. And I'll start with the big news, which is a Rocket Mortgage not only bought Redfin, which was about a couple weeks ago. Now they're also purchasing Mr. Cooper. Mr. Cooper being, I would say, one of, if not the largest mortgage servicer in the country. So, you know, it's pretty obvious that Rocket's making a big move right now to not only really get into the real estate side of the business, but also the servicing side of the business. And look, I mean, a lot of mortgage companies have sold their loans to be serviced by Mr. Cooper. And now Rocket has an opportunity to try to recapture a lot of that business. You know, this just reminds me of what's going on with interest rates right now. For those of you in the mortgage space, you've noticed that every lender is, you know, it's a price war out there. Every lender's rates are a little bit different. And you might wonder yourself, you know, why is one lender better than another? I mean, isn't the price of these mortgages all the same? And it is. And you might think it's because one's trying to make more profit than the other. But I assure you, although that might be the case in some instances, it's probably not. I mean, the margins are super, super low. I don't think there's a lot of mortgage companies expecting to make a ton of profit right now. What you see in the difference is companies willing to pay more for the right to service that loan. And why would they do that? Well, they expect an opportunity to restructure that loan, refinance that loan, recapture that loan down the road. So if you're a broker or if you're an independent mortgage bank and you are choosing to do your loan with the highest bidder, if you will, the highest bidder for servicing, which means the lowest rate on your rate sheet, they're banking on their ability to recapture that client better than you can. And, you know, they have statistics that obviously indicate to them that they will have some success in doing that. And so we see this rampant right now. You know, I work very closely with our capital markets team, and I can tell you that there is some crazy multiples being paid right now on servicing. And when you talk to these companies, it's because they expect to redo that loan 2, 3, 4 times in some instances. And then they've taken that additional revenue they would make in the future, potentially, and put it into the price today and are paying more for that servicing. So just be aware of that. You know, it does mean that you need to look at multiple different investors when you're pricing out a loan, but it also means that you have set yourself up for some significant competition for that loan if interest rates drop in the future. And that's what they're banking on. They're paying for it. And if selling the absolute lowest rate to your customer is your primary value proposition, and that's what you feel like you need to do, just know that you might be giving away the next loan that you would have had with that client in some instances. Or make sure you're working very hard to stay in front of that client for years to come. So interesting fact, but it's rampant right now. And you see some pretty significant spreads between investors, and they come and go, you know, they change their strategies. And so if you're seeing that, that's what's going on. I mean, Fannie Mae is only going to pay so much for a loan. The rest of that money is the servicing value, and it's all over the place. It really is. So keep a close eye on that. A couple things about the economy that I thought I would touch on. You know, jobless claims, we talk a lot about the unemployment numbers and, you know, non-farm payroll numbers that come out the first of the month and so on and so forth. Everyone watches that kind of headline, if you will, and certainly it's the most important. But what's also interesting is, you know, we look at jobless claims, and although they've been kind of vacillating up and down, staying, you know, fairly much in a range, what hasn't been staying in a range and has definitely been trending up over time is claims. And so what that means is that although unemployment, the event of someone becoming unemployed, is going up and down, the amount of people still outstanding that have not found a job is continuing to increase over time, which tells us that those people that are getting laid off, many of them are not finding new jobs. And so the ongoing claims is growing over time. Not a great sign for strength in the labor market. So that's one of those kind of secondary type of reports that you don't hear as much about, but definitely is interesting to watch. And there's no question on what direction that's moving is claims are up over time. I thought it was interesting that the Atlanta Fed, who historically has been predicting, 3 to 4% GDP, has revised their GDP expectations to negative 3%. That's the Atlanta Fed. So they are anticipating a recession. I thought that was interesting bit of news, not just because they're anticipating a recession, but because it was such a reversal from what their position had been in the past. I don't know what's driving that revision, but again, another sign that we may be heading towards some level of recession in the United States. Corporate profits are down. That's not good. I was listening to a podcast the other day talking about corporate bankruptcies, and there is more than there's been in a very long time, since like 2011 or 12, I believe it was. So really since after the financial crash. But corporate profits are down, and there is a lot of government fiscal tightening, and it is expected that government profits, especially obviously those companies that rely on government contracts, that as you see fiscal tightening, it will only escalate the downturn in profits for companies. Really, I would say across the board, but obviously primarily for those that rely on government contracts to keep them going. I thought it was interesting that rents are they're up slightly. If you look at the graph of rents, they really peaked just post-COVID, right? They were astronomical. They came down significantly. Look to me, based on the graph, they kind of hit their low in mid 2023, and they've just been slightly increasing over time. So, as far as the measure of, affordability of housing, right? So if rates go up, yes, we know that purchasing a home is as unaffordable as it's been, but this closes that gap a little bit. And although rents have been super low in mid 23, it did nothing to impact the price of homes. We did not see home prices drop as a result, which you would think would typically happen. We're starting to see some softening now in some markets around housing. We're seeing more listings, more inventory, more price drops. So it'll be interesting to see how those numbers play out. I did mention, I think in my last market update, that year over year appreciation was still over 4% on pretty much every read of appreciation that you can find out there. But nonetheless, rents are steadily increasing. At my last market update, we did not have the PCE number for February, and PCE did come out last week, and it was up 0.4. So that was higher than expectations by just a smidge. I had told you guys that I had watched a pretty good breakdown from MBS Highway about their prediction on PCE and expected to be a little bit lower. I have not listened to kind of their breakdown of where PCE came in and what the differences were. Doesn't really matter, although I'll probably go back and watch that just for my own edification. But nonetheless, it was up. But what was interesting is the bond market didn't seem to flinch. I mean, bonds were actually better that day, although slightly. So that's interesting that we saw a high PCE read. I think it's because the expectation was there, and there must have been some, underlying data that the market felt good about. Probably something around, consumer sentiment and some of the other very poor reads that we've been seeing of late that are just not showing really strong for the economy. I'm just being honest with you. Lots of things, in my opinion, pointing towards at least some amount of recession. If not, we might already be in one. So that's interesting. Now, here is some good news that I loved. I just went and looked at the 10-year right before I recorded this, and today is April 1st, although this is not an April Fool's joke. The 10-year did dip below 420. It's actually at 4.161 at the time of this recording. But I look back, and on January 13th, I think that's when it peaked. I just kind of looked at the graph, and it looked like it was right around January 13th. It was at 4.78. So from 4.78 all the way down to 4.16 right now. And although it's kind of as you would expect, it's a little bit of a jagged line down. It's definitely a straight line down with some ups and downs along the way. But the trend, I guess my point is very much in the downward direction. And that's what we need to see. We've talked about this. We need to see the 10-year continue to march down, and that is going to directly correlate to a drop in mortgage rates as well. Matter of fact, I was just talking to one of our branch managers, and there's actually quite a bit of refinance activity starting to pop off right now. So I wouldn't say we're at the point where everybody could benefit from a refinance, but there's no question that we're already starting to see some refinance activity pick up. So as I've mentioned numerous times, you think back to last October when all of us were ready to refinance the planet, and we had about a 2-week window, and then it slammed shut. And those opportunities, as I mentioned, throughout 2025, it may not be consistent, but there will be dips. There will be windows of opportunity to refinance your clients. You have to have them teed up, trigger rates ready, know where you need to be, dial that in. It is harvest season, not like, not a full harvest, but there will be little bits and bites and opportunities, and you need to be just ready to jump on those. There should be proactive communication with your database. I would say, keeping them updated via email and whatever CRM system you use is great, but phone calls, you guys, phone calls, talk to people every single day about what the market's doing, when might be a good opportunity for them. Interesting fact, incomes were actually rose. So incomes rose. That can be inflationary. Incomes rose, but spending was down. So what this tells us is that the average household is concerned. We talked about consumer sentiment. It's down. It's as low as it's been in a very long time. And so although incomes are up, it's normal for Americans to spend every dollar they make. And so this is interesting. People are holding on to their money a little bit more. I think that is obviously in anticipation of the uncertainty, potentially pending recession. And look, since I've mentioned recession like 5 times already in this podcast, I think it's important to point out, recessions aren't typically bad for the housing market. Matter of fact, in most recessions, besides the great meltdown that we had in 2008, usually it's good for housing. And it's good for housing because interest rates come down during a recession, and that spurs activity, and it's typically good for the real estate market. So I just want to point that out. When you hear me say recession, I sometimes might say it with a little bit of a grin. I don't want a recession because that's pain for a lot of people. But in the mortgage industry, it's one of these weird phenomenons where we tend to do well during a recession. And so although it's not what we want, I would rather have a strong economy and a strong housing market. That's ideal. But this will force interest rates down. To me, it begs the question if the current administration knows that they can't impact Jerome Powell and the Fed, and that they have to create circumstances that will require them to lower the Fed funds rate. And some of the moves that are being made and the disruption that it appears to be creating might make you wonder, is some of this intentional to temporarily slow down the economy, bring the interest rates down? I don't know. Maybe that is, maybe that's too big of a, of an idea. I don't know. But look, there's a part of me that goes, I wonder. So consumer sentiment down. I mentioned that. And consumer sentiment is one of those leading indicators. And part of consumer sentiment looks at what consumer sentiment is today, and it looks at forward-looking consumer sentiment. And the forward-looking number is even worse than the current number. So look, the consumer is not feeling good right now. They're very uneasy. Now, could that spill over into real estate? Like, let's be honest, if you're the average consumer and you're concerned about the market, you may not know what we know, which is that interest rates get better, affordability comes down, and buying a home is something you should be considering during a time like this. But let's be honest, the average consumer doesn't think that way. They think market bad, I'm going to hold on to everything. Why would I buy a house right now? That's really scary. So we have to understand that and be willing to talk through that with our customers. But the forward-looking consumer sentiment number, it was even worse than the current one. So that's not good. And consumer expectations around inflation, you guys, this will blow your mind. The consumer expectations. Now, again, this is not what the market's predicting. This is what the consumer is predicting, is that inflation is going to reach 5%. Now, I do not think that that is going to be the case. I do not see a circumstance in which that happens. We've talked about the tariffs. We've talked about the stuff. Nothing to me indicates that, but that's what consumers think. And I mean, if that did happen, that would be horrible. But these are I think what's important takeaway about this is that us understanding what's going through the consumer's mind right now is really important as we advocate and advise people through the mortgage process. You know, I often have to remind myself that we all live in a bubble. Like, I'm not a market expert per se, but compared to like someone who manages a hedge fund or something for JP Morgan Chase, like I would expect that they would know a lot more than I do about the market, but I know a lot more than the average real estate professional or the average consumer. And so both of these are people that I interact with all the time, real estate agents and consumers. So it is, you know, we think that because we know how some of this stuff works, that we assume that everyone else kind of understands how it works. And the reality is they need our education. That's part of the reason I do this podcast, is to give you simple talking points to talk to your real estate agents about, talk to your clients about, maybe some ideas. We don't dive deep into any of this stuff, but you can go do the additional research on your own. I'm just bringing you some of the things that jumped out at me as I'm doing my research. So I'm like, if I'm a mortgage professional or a real estate professional, I want to understand more about these kind of core areas, because these all impact our customers and our clients. So you guys, that's really all I had for you today. I just wanted to bring another quick market update. I'm doing more of these because it's so relevant to what's happening. I mean, things are moving in very real time. I hope that you appreciate the content that we're putting out here on market shares. If you do, please share it with someone that's in your office or someone else that you know. If you're already subscribed, thank you. If you're not, consider subscribing to the channel. That way you'll see our new episodes that drop every single Friday at 10 a.m. Pacific time. And until then, take care.